YouTube, please let me know how the sound quality is. If you're on X, please let me know in a reply to this tweet how the sound quality is. Let's go through the markets real quick. Overall markets today are down. Dow Jones down 1.5%, Nasdaq down 1.6%, S&P 500 down 1.5%. It's across the board. The markets are down today. Across the board, markets are down, except for a handful of stocks. It's a very much a risk-off type of day. Walmart is up. Costco is up. And a couple of the energy stocks, oil stocks are up. You know, utilities are down. That's kind of interesting. And Philip Morris is down. That's kind of interesting too. So in a normal risk-off kind of day, you would expect utilities to be higher. I mean, I guess utilities could be lower because of the fires, I'm guessing. But that would be more company specific. So maybe we can take a look at that real quick. And then, okay, Walmart up, Costco up, Target up. Now, look at this. Pepsi is down. Philip Morris is down. The Mondelez International is down. These are companies you would expect to be higher if it's a normal risk-off kind of day. So that's an interesting observation. Looks like a lot of companies are getting hit by these kind of prospects of higher interest rates. Look at the financials. Wow, financials are down big time. Berkshire Hathaway down. I have a small short position in Berkshire Hathaway. JP Morgan is down. JP Morgan is going to announce on Wednesday. That's going to be a big one. Visa down 2%. MasterCard down 2%. PayPal down 6%. Banks are down pretty big, 2-3%. And BlackRock is down. Blackstone's down 4. BlackRock is down 3. KKR is down 5. Yeah, I mean, asset management, private equity depends a lot on leverage. So to the extent that cost of leverage has increased today with the surging yields. I mean, surging yields is the story of the day today. Healthcare, mixed. Medical devices are down. Drug manufacturers, healthcare plans are up. Oil stocks are up, like I said. Yeah, really interesting day. Quite the picture. Uber is up 2%. Anyway, so that was one day performance. I mean, a lot of things changed today after the employment numbers were released. The job additions were way above expected. Job additions came in way above expected. Maybe we can take a little detailed look at this. But so the economy doesn't appear to be in a recession at this time. Initial weekly claims are also lower than you would expect in a recession. If a recession was starting, the last read was ticked down. Job creation in December is higher. But if you remember, things kind of took a turn down mid-December. And so this is still dated information, but we'll see. The job numbers are obviously non-farm payrolls are adjusted heavily as well like they're revised heavily in future months. So I wouldn't place too much importance on it. Unemployment rate ticked down to 4.1%, lower than the 4.2% expected. Average hourly earnings came in at a healthy clip, 0.3%. That's kind of where you want it on the 2% inflation rate. So that's just as expected. So there's no issues there. The one thing that was interesting, the one reading that came in, like this is after the jobs report. So at 10 a.m., University of Michigan consumer sentiment preliminary numbers for January were announced. So job numbers for December. Okay, this University of Michigan consumer sentiment is for January. And I think there's a bit of an issue starting mid-December. So, another interesting thing here is to the extent that there's some variability, some stochasticity in these numbers, some unexplained variables from month to month changes. The fact that this one was up quite strong, almost double what was expected. Could also mean a bit of a lower month or maybe revisions down when the next number is announced. So that we're talking, that would be first Friday of February. So we're talking, first, let's see, when is first Friday of February? February 7th. Yeah. Oh, February 7th. So I think there's a bit of a potential um, downward surprise in February 7th. But anyway, that's a little far away. Next week, we're going to get the inflation numbers, CPI, PPI. So if these numbers are combined with a lower than expected inflation numbers, then you have, I think the stocks can go up at that point. But we'll wait. We'll wait to see. Initial inflation nowcast shows um, inflation is still expected to be higher than normal. At January 2025 forecast, core PCE forecast is 2.6%, but that's down from 2.87% in December. And PCE number headline is supposed to be 2.4. Um, and then on CPI, year inflation is expected to be 3.28%, 3.18% core CPI. So that's still above where the Fed. So I don't think that's going to change. Like right now, if the Fed is primarily worried about inflation picking back up again especially after these employment numbers here, the unemployment rate coming down, the wages kind of staying at 0.3%. Um, I don't think the Fed is going to be worried about. So that is the result. The market now expects only one rate cut for the rest of the year. So in 19 days, we're going to get the next Fed meeting. The probability of a cut is 2.7%, dramatically lower than before the meeting. I mean, about last week, it was double digits, 11%, and it's now only 3%. Um, and then end of December, we're looking at the median expectation of 4 to 4 quarter. So just one cut. And it's actually tilted towards no cut. So it's possible that we don't get any cuts this year, any rate cuts. Now, what does that mean for Tesla? I have a short position for Tesla. I added to my short position this morning and pre-market as well. And after these numbers came up, because the treasury yields jumped up very substantially, especially in the morning, and especially in the part of the treasury curve that that could be problematic for Tesla. 5-year treasury yield is up currently at 9 basis points. Um, they come down a little bit throughout the day. That's why you're kind of seeing these stocks go up a little bit, recover a little bit throughout the day, especially Tesla as well. But in the morning, 5-year treasury yield. Oh, actually, look at this. I mean, they're kind of going back to where they were in the morning. So the stocks may turn down here. So maybe I should add a little bit more to my Tesla short. Tesla just turned positive at $396 per share. 5-year yield is at 4.57. In the morning, it was as high as 4.58. So the entire yield curve, is kind of closing up on 5-year level. I mean, 5% level. The 20-year bonds. I'm also looking to go long the long end of the curve, because I don't think the economy can sustain rates above 5%. But the 20-year treasury yield is now at 5.04% as of today, up 6 basis points. This morning, they were as high as 5.07%. So in the last 5 days, they went up 20 basis points. And given this 20-year treasury has long duration, a 20 basis point move in a matter of a couple of days is insane for this part of the curve. In September 2024, they were at 4%. So more than 1% higher in just a matter of 3 months. And obviously, part of this is the Trump fiscal policy. I think markets are starting to price in, or have been pricing in the Trump fiscal policy. Higher budget deficits, and now you have Elon coming out and saying they're not going to be able to do $2 trillion, maybe more like one. And as I've been saying, since the election, it's very unlikely they're going to be able to find $2 trillion of cuts. And people smarter than me on fiscal policy expect no reduction in fiscal spending this year or next year. So that would be a very different outcome than what Elon and team has been talking about after the election or going into the election. So he's already backtracking from that $2 trillion figure, and I'm guessing they're not going to be able to do. I don't think they're going to be able to cut at all. Honestly, the budget deficit, which is a very significant problem. The high budget deficit as a percentage of GDP is a very significant problem, and we're seeing these long end of the curve, 10-year, 20-year, 30-year part of the curve surging towards 5%. And today, 5-year treasury yield, which is more important for auto loan rates, is also up 9-10 basis points. So this is very problematic for home builders and automakers and companies with high PE ratios, companies who depend on consumers' ability to borrow money. So Tesla is at the intersection on all of those negative headwinds. People need to borrow to buy cars. Tesla stock has a very high PE ratio, and I think home prices will also start declining quite a bit now after these recent mortgage rate moves. Mortgage rates are above 7% again, and in some parts of the country, in some demographics, you're seeing as high as 8% mortgage rates. So, yeah, I don't see how this ends well. But I see ACDC. If he can come up, maybe we can bounce around some ideas. Otherwise, let's look at other stocks a little bit. Actually, let's look at the Model Y news. Let's do that. The new Model Y. I heard some mixed reviews on the design. Um, I saw that. There is. First of all, ACDC, welcome.
Thanks, Iman. How are you?
Good. What did you think of today's numbers?
So yeah, just a little bit on that. I've been doing this long enough to know when the job reports, a strong job report is considered a positive, and the market actually does reward it. Okay,
Mhm.
but we're in times where the market is not looking at the strength of the job market, which should be a positive, and instead it's looking at this as a negative because there's no more easy money. Okay,
Mhm.
so that it tells you exactly how much strength there is in the market right now. Okay. The market is dependent on easy money that came at it in the last 4 years. Somewhere along the way, we have to pay the price for that easy money. Okay. And that, in my opinion, that price is going to be in the next few years, including this year. Okay. And if you look at all of the stocks that are getting hit the most, okay, what happened to AI? I thought AI is supposed to increase efficiencies. More people are going to adopt it because of a tough economy. No, all that crumbles because all of this is based on the premise of easy money, basically. Okay. And that's why this is not a positive news. That's why this is a negative news. There's a lot of missteps that the Fed has taken, the government has taken in the last 4 years, and the bond market is making that correction for them.
Yeah, exactly. So going into this 2025, let's focus on the S&P 500. What is your top pick?
Top pick as an individual stock.
Yeah, or a theme, maybe a group of stocks and industry going into 2025, which look appears to be a high interest rate environment, an environment where maybe the unemployment rate, stays above 4%, maybe between 4 to 5%, kind of goes back and down a little bit. I think it's going to drift upward, but it hasn't started yet. It's actually ticked down in the last couple of months here. Um, and then um, let's say um, stocks are, yeah. Just assume that. Assume 4 to 5% unemployment rate, and assume interest rates are at 5%, and maybe a flat yield curve. Slightly positive yield curve.
So
Strong
I'm kind
U.S.
of at,
dollar. That the other thing is strong U.S. dollar, right? Some questions around growth in international markets. Yeah. So with that backdrop, what's your top pick, top theme for 2025?
so there's a few different themes, and I'm in the process of actually kind of making those decisions right now. So usually at this time of the year is when I'm analyzing exactly what you said, some themes, and aligning my portfolios according to those. And in some industries, I'll buy ETFs, and in some, I'll actually pick up individual stocks. Okay. So I can't, I mean, maybe I could if I was to narrow down a theme. Okay. But I'll give you a few of the themes that I'm looking at. Okay. Overall, I'm focusing on value. Okay. Not the growth stocks, but value stocks. Value stocks have actually become deep value stocks. Okay. And especially in certain sectors. One of the sectors that I just caught my attention is the food sector. Okay. I mean, think about that. This is a sector that we depend on. This is a sector that we need, and it's literally collapsed. Okay. So there's some deep value in there. There's an ETF called MOO, literally MOO. Okay. If you look at that, it holds a lot of these companies. There's companies like Conagra, CAG, that you can look at. I mean, these companies are paying 5% dividend. Okay. And they're trading at single digit multiples. Now, this is not a high growth industry, but when it goes into such deep value, these stocks can rebound 10, 15, 20, 30% in a heartbeat. Okay. So that's one thing that I'm looking at. I think financial industry is going to be very interesting, and that's something in which I will not buy an ETF, but specific plays. I think people or institutions, financial companies, which have acted with prudence and have a good, strong balance sheet, will continue to make good profits in this high interest rate environment. Okay, you just have to weed out the ones that really are heavily dependent on commercial mortgages, commercial real estate, and have just are holding bad paper basically, or a leveraged book also. Okay, but there'll be some names in that that are going to be good. And overall, the other one that I'm looking at as a team and a sector, and I think I told you this over the last couple of months, is the utility sector. I think that's also a defensive play. That sector overall has backed down here. It had got a little lofty, and I think that's still going to offer not just a good yield, but some really good growth overall also. We're dependent on this, and if anything else, the demand from all of these data centers, there's just and also from all of the stuff that you're seeing, we're going to need all of this. So in that sector, what I'm actually going to look for is some of these utility companies, which are actually focusing maybe also on the nuclear side, because I think that's also going to come up in the coming years, where with the help of regulations, these companies will be able to kind of leverage the nuclear side of their business more.
Gotcha. Thank you. So you talked about the agribusiness ETF, NOO, and you also
M as
talked
in
about,
Mary. Yeah,
yeah,
M as in
exactly.
Mary. Oh. Yeah.
Yep. And then you talked about utilities with valuations coming down a little bit after they got a little lofty with AI theme. And then, so there was something else in between. What was the other one in second one?
It was financial companies. So that's where I will not be going with a broad-based sector. There's some ETFs on
Right.
the financial sector and also on the regional banking sector, which I have used in the past. So I did buy like it's the S&P KRE. That's a regional banking
Right.
ETF. And if you recall, like this was like what 3 years ago when a few of the
Right.
regional banks kind of went or turned upside down. The FDIC had to step in and everything with the whole crypto involvement. The whole sector sold out. So at that time, I bought it because I'm like, no, there's some really good regional ETFs, and it rebounded back sharply. But right now, I wouldn't want to focus on the sector as a whole. But there's some really good financial companies, and they're going to continue to have healthy margins with these high interest rates.
Yeah, definitely. Would you look at Visa, MasterCard at all?
Not really. Like I said, I'm at these times because no matter what, okay, it's so hard because when the market as a whole is so overpriced, appreciation across the board gets capped, right? That's why I want to really, really look at deep value plays. These both of them already have good multiples built into them, and these are companies that make money when there's high transactions and the frequency of transactions. And overall, I do see a slowing economy, and they're also going to suffer with that.
Yeah. Yeah. Okay. Um, all right, I'm gonna look at Mo, but that's a so it looks like Deere and Company is number one as holding there, 8%. Zotes is under 8%, Corteva 7%, Nutrien 6.4, etc. So yeah, interesting. Interesting. Why
Yeah,
why
and
did
so
the why did prices drop so much in those in that segment?
like I said, I'm still looking at it. It's hard to believe. I think part of the reason really is that all the money has been going towards growth. People are crazy. People think that technology and AI is just going to lead us into everything. Not everybody's buying AI and technology, and not everybody works for AI and technology. Okay, so the investments I think are heavily, heavily pouring into that side, and this is where mispricing occurs, where a lot of these sectors, essential sectors, defensive sectors, just get completely ignored. And of course, you'll have some interest rate impact on them and stuff too. But these are companies mostly with good balance sheets, and strong balance sheets. So I don't see them like a hugely negative impact. They'll be able to
Yeah.
sustain that.
I mean, yeah, Deere and Company trading at 16 PE with a 1.6% dividend yield, under than $11 billion market cap.
Yeah,
Interesting.
look at Conagra. Okay, that's
Hmm.
one of the largest packaged food, you know, companies out there. I mean, that I think is single digit PE, and I think it's around like a 4% or so dividend here.
Mm. All right. You want to talk some Tesla? What do you think of the new Model Y?
I like it. I think it's refined. I own a Model Y. I own the older one. If you were to put them side by side, not, I mean, and strictly to take my bias out, I think I would still kind of like the older shape a little bit better. The light bars are cool, but just overall, like the curves, I think on the older model appeal to me a little bit more. This is like a little bit more just kind of straightish, but some of the features are pretty cool, like a better suspension. That's a good thing. A rear screen for many, that'll be a good thing. Um, Better range. I think that we haven't heard any numbers, especially for the US, but better range. I think that to me is the number one thing needed. If they could add like 50 miles more range, it would be a huge, huge difference.
50 miles. I don't think that's going to happen. But there's some range. So this is it's very much like the Highland upgrade. Um, there's a screen in the back, some changes in the front. The front chain's a little different for Model Y than the Model 3. But the interior upgrades are pretty much there's the ambient lighting and everything, very, very similar. And the range improvement is also the suspension improvement, the acoustic glass improvement, they're all very similar. Um, there's some similarities with the Cybercab Cybertruck design in the front, with the light full width light bar, front and the rear. Um, Ventilated seats in the front, quieter ambient lighting we talked about. Um, the back seats can be folded down electrically and expand the total storage capacity. Okay, so that's good, but not. I don't think this is a game changer. I don't think it's a game changer. The sales are still gonna struggle about from high interest rates in the U.S. I guess China is a little lower. Interest rates in China have come down quite a lot, and Europe is going to come down as well. Range, I think there's a slight improvement in range, but that's primarily because of the coefficient of drag, the drag coefficient, right? Went down from 0.23 to 0.22. I think that's a primary driver of the range improvement. So, um,
And I
which
think
is
maybe
which is
a
very
slight,
similar to Model 3, which is very similar to Model 3 Highland upgrade.
yeah, and maybe the range that they're touting is also from the slight reduction of weight that they've also said. So probably, I think you're right. Maybe not. It's not battery related, which is where I would like to really see the improvement. I think that's been my biggest struggle is not on local driving, but on long trips. That's something that I would pay extra for. In fact,
Yeah, yeah. Yeah, that's not happening. Steven?
Hey, Iman, so I was going to ask about the Cybertruck. It doesn't seem like the design of the Cybertruck has been very well received yet. So why would you design your Model Y redesign after the Cybertruck that no one seems to like the design of? That's what I don't understand. Why wouldn't they want to separate further from the Cybertruck rather than
Well,
start to make
the
something?
part of the design that people don't like about Cybertruck, or let's say most people are having a difficult time adjusting, is the stainless steel body. And obviously, that's not the case for the Model Y. I think people like the front full width, light in the front for Cybertruck. That's actually my favorite thing, especially at night when you see it. I think that's going to bode well for Model Y. But I guess one difference here is Model Y refresh and the Model 3 refresh is that when you see a Model Y refresh, nobody's going to say this is the old Model Y. Like people will know this is a new one. You know, it's not going to be as innovative as the Cybertruck, obviously, but it's also not going to be as a lot of people I think miss. Like I ask people, "Oh, have you seen the new Model 3?" And even after like a year, they're like, "Oh, I haven't seen it," because they're thinking it's like it's the old Model 3 when they actually see it. Like they're definitely around. Um, but people can't tell. The range improvement. Oh, look, the new Model Y is priced from $35,900 in China, 263,500 yuan, 5.4% more expensive than the previous version in China. But that's going to decline. I think the new Model 3 also started a little higher, but then I think it declined if I remember correctly. And the Tesla's second largest market, the US automaker said on its Weibo social media account. Deliveries at China are set to begin in March, subject to regulatory approval, and Tesla was also taking orders for the SUV in many other Asia Pacific markets. Details about Tesla's plans for the revamped version of North America and Europe were not immediately available. So obviously, this is going to hit. Um, like this might hit the sales in US in Q1 and Q2. Like let's say it doesn't come to US until mid-year or Q3, that you're going to see some cannibalization, some what effect it's called again? ACDC?
Osborne.
Osborne effect, yeah. There's some Osborne effect in Q1 and Q2 sales. So I think I'm at 420,000 units sold for in Q1. I have a bet with somebody at 455,000. He took above, I took under. So I think I'm going to win that one. And Troy wasn't happy with leaked pictures of the Model Y. Troy wasn't happy with leaked pictures of the Model Y, but I didn't see. Let me just check if he says anything about the new one. Um, 16 hours ago, he posted that the order page was open for the new one. Roy says the Model Y new design looks like it was inspired by the Cybertruck. Elon probably told France to go for that look. Let's hope it works out well. I guess that's Steven's view as well here, that it's not going to work out well. Let me see if he posted anything.
I don't think it is, sir, but I'm definitely not any type of subject matter expert. I'm just a consumer, and from my consumer perspective, I don't think it was a wise choice. It's not making me consider to go get a Tesla right now. I mean, some of the body styles that they have are nice. This just isn't one of them for me. Sorry to
Yeah,
jump in.
yeah, yeah.
Do you think this will attract new customers, Yaman? Do you think this body style is going to reach out to, because, California, they're continuing to lose market share in California, so they're going to have to pick that up somewhere. So hopefully someone in 49 other states, like this type of car, but I don't know.
Yeah. I mean, I don't think design was the Model Y's problem. I mean, Model Y, first of all, Model Y is the best selling car, so we have to recognize that. Secondly, I don't think design was the limiting factor on sales. I think it's just interest rates are high and they continue higher and this year. So I don't expect a very huge change until interest rates come down substantially. And Model Y sales, ACDC?
I agree with you, and I think in that way it's kind of a little bit of a mistiming. It was, of course, due for a refresh, so they went with it. Maybe could have waited another year because, like you said, interest rates are high, so that's going to put a pressure on the pricing, and then we also have the federal tax credit that could be gone. Which I
Mhm.
actually wanted to get your take on also on that. The people talking that this will be in place at least till 26 or till 25, and then they'll be taken off calendar year 26 for tax purposes.
Mhm.
And if that's the case, it could get a little bit of a bump here with last minute people trying to get in and ordering the new one.
Yeah, maybe. Who knows? But I don't think that's a huge factor in intrinsic value calculations. So, yeah, you might get a bump this year. Maybe let's say if it stays this year and goes away next year, who knows? But Tesla's a global company. But they're global sales. What percent? Let's say, for example, another 5%, 10% of like Model Y sales go up 5%, 10%. I mean, that's like 10, 20,000 units in the US because only US only applies to US and only applies to people who actually qualify for the income limits and everything. And so does it really matter if it's 1.8 million and the second digit after the period is 1 or 2? It doesn't matter. Or
I agree.
if the margin is like another percent higher, it doesn't matter. Not really.
I
For
agree with
one
you.
year, by the way, yeah, for 1 year.
Right. No, I think apart from a little bit of a maybe increase in sales, this is basically just a replacement of the old Model Y sales. I don't think this is a product where it garners any new interest and becomes like, the new thing in any which way. So it's just the old Model Y sales, will just go to the new Model Y. And what I would have liked to see if I'm an investor in Tesla is if somehow the timing was right and the changes were so good that they were able to maybe charge more and they had that pricing power. Unfortunately, they don't right now. So that's why I say that the timing is also wrong because you would like to see, I mean, that's what you want to see from a company. If the products are great and the adoption is good, you want to start to see the pricing power. You've seen that in Apple and all successful products, right? You want to start getting back up to that. So instead of maybe going down, you'd like to see the Model Y start to get to the 50, 55, 60 on their different lines.
Yeah, exactly. I mean, the primary challenges at Tesla are high interest rates, consumers. The second one is consumers are picking hybrids over pure EVs. The third one is your CEO is not compensated and he's not focused. Now there's XAI that's kind of competing for resources with Tesla as well as SpaceX and other companies. And then, fourth one. So what did we say? We said high interest rates, shift towards hybrids. CEO is all distracted, and FSD. FSD is not improving at the rate that was hoped a couple of years ago. I'm watching, still kind of keep an eye on Tesla FSD tracker, despite the fact that they removed trimmed mean, which I think is essential. But all that does is, with trimmed mean, you could rely on a few thousand miles of data. Now you have to see tens of thousands. Like, you definitely have to see tens of thousand miles of data if they remove trimmed mean. So from thousands of entries and everything. So the V13 is now up to about 7,000 miles of entries. So you still don't have, technically enough data. Okay. But if you remove V13.2.2.1, which only has like 2 people entering data, if you remove that, you're looking at 96%, and it's been consistent over the last couple of weeks. Only 96% of drives are completed without a critical intervention. Okay. And that's not changing. And that's only AI 4 cars, because hardware 3 does not have V13. So V13 is struggling to low bar that I set with 96 to 97%. I said when a couple of months ago, I said 96 to 97% will be the percentage of drives without critical intervention, and miles between critical disengagements will be at about a few hundred miles. And that's exactly what's happening, despite only data only coming from AI 4 cars. Okay, so that's actually worse than I expected, because I was considering at this point Tesla would have started rolling out the hardware 3 cars as well, which doesn't look like it's going to even happen at all, because they're sending out 12.6 to those cars still. So they're not going to be 13 anytime soon, I don't think. So like I said, we're going to know more. I think we're going to get to tens of thousands of miles logged in to FSD tracker on V13 by March, which is like end of February, beginning of March, I think is what's going to happen. And I've been saying this since September, when the AI team started talking about wide release in Q3, or I think they posted in July or something. And I said, there's no fucking way it's going to happen until spring. And that's how it's happening. So those are the main, like a handful of main headwinds around Tesla stock. That's not changing. That's still there. All of those things are still there. Doesn't matter if non-farm payrolls are 200,000, 500,000. Doesn't matter. Your interest rates are a little higher than before, than yesterday, the day before, etc. New car loan rates are 10%. Used car loan rates are still like 14, 15%. So the one thing that's different today than yesterday, the day before, Elon saying comments around Optimus. Elon says something like they're going to produce 5,000 this year, 50,000 next year, and 10x after that the year after. And I just don't think that's going to happen. Like, I think he's just being optimistic again. Steven?
Yeah, no, the bots is a joke. But I was going to ask you, sir, about the FSD tracker. From going from version 12.5 to version 13, I mean, it kind of indicates that they see a 3x improvement. But there was also a change to the way Elias is reporting on FSD tracker. I was just wondering if you thought version 13 was a legit 3x increase from the previous version, or do you think something's getting lost in the numbers?
It's not. It's not. It's obvious not. It's moving exactly as previous data suggested it would. And so I see no reason why in the future we should see a massive acceleration. The thing that's missing on FSD and Optimus now as well is an algorithmic breakthrough. So something like transformers. Transformers is probably, on the AI front, probably the most important innovation in the last 5 years, let's say. Maybe Meta would disagree on that, but we'll ask him if he comes here, or Wes. In my opinion, transformers are the most innovative or most consequential, most material innovation in algorithms. And because of that, even we're talking about ChatGPT or these large language models, etc. And even Tesla is using transformers as well in their models. So something like that can come around and just immediately drop the need for buying $100 billion of GPUs, because that's exactly what Tesla is going to have to do. If nothing comes along that is 0 to 1, the next is 0 to 1, like Transformers doesn't come along, Tesla will have to spend $100 billion on developing FSD, perfecting FSD to the level that is necessary for robotaxis. Okay. And so I think something really changed on this front in the last year or so, like in people's minds.
Could you briefly explain the transformer in language models? Because I am definitely not up on it, and I like it maybe just briefly because I have no
Yeah.
idea what.
So yeah, essentially, transformers allowed um, running massive models, training massive models with at a higher pace of calculations, like in parallel calculating. Okay. I mean, you know what? I'll just ask ChatGPT. But
I mean, that makes sense. I
like
mean, I know
it's
enough
have
about
you
it.
ever done matrix? Have you ever done matrix multiplication?
No,
Okay.
I'll just chat GPT it also, I think.
No, hold on. Let's do it together.
Yeah, man, while you do that, I just wanted to add one more thing, and it's the fifth reason that I think is a valid reason, which
Hold
is,
on. Let's finish this first. Transformers are revolutionary architecture in AI, particularly natural language processing. They underpin many of the most advanced AI models today, including OpenAI, ChatGPT, etc. Transformers are a deep learning model introduced in the paper Attention is All You Need. They excel in handling sequential data, text, audio, video, by leveraging an attention mechanism to process input data in parallel. Okay, so you're processing data in parallel, so you're doing it much quicker. Unlike traditional models like recurring neural networks, RNNs, that process sequences step by step. And if you want to read about the math behind that, just look up matrix multiplication. Okay. I mean, that's sort of, there's a lot more detail. So if you want to kind of dig into this hole, you can keep reading it and everything. But essentially, you don't need like, because you can calculate things much faster with transformers. It allowed creating these models. They're capable of things that you would need a lot more processing power in the past. So instead of spending trillions of dollars to create ChatGPT, you can do it in billions of dollars, let's say. So that's a 3 order of magnitude improvement. Okay, I'm doing that for illustrative purposes. The way things stay today, the way things stand today, without such a step change in an algorithmic breakthrough, Tesla will have to spend tens of billions of dollars, and by my estimate, higher end of tens of billions of dollars, so about $100 billion. So not trillions, but not 10, $20 billion. We're talking high end of tens of billions of dollars, probably more like $100 billion in buying GPUs, building data centers, um, you know, engineering hours, etc., to perfect FSD to 99.9999% reliability. And obviously, Tesla doesn't have that money. Tesla can't do $100 billion. And even if it did, you can't just throw money at the problem and all of a sudden it's done. It has to be scaled. So the way things stand today, Tesla can't compete with Waymo on autonomous driving. Google has more cash. They're vertically integrated in R&D on AI. They're the ones who invented transformers, and they're also not scaling their cars as well. So I think Elon was banking on another algorithm breakthrough that just doesn't seem to be coming.
So what's next on the AI front then? Do you think? Do you, like ACDC? I think he was talking about earlier when I first joined that. Have we kind of plateaued in terms of advancements, and now it's like kind of, just I don't know. What do you think? Or ACDC? Do you have what were you saying earlier about it?
ACs.
So what I was talking about was more on the valuation side of AI and not really on the technology side. But the technology side also, I think, has kind of plateaued in terms of ROI. Okay. If you look at all of these companies that have invested heavily into AI, they have to show a certain ROI to the shareholders. And that just hasn't caught up yet. So somewhere in there, they have to reduce their spending or at least minimize, sustain it at the level that it is and not increase it any further before they're able to show a significant ROI from those investments.
Okay. Yeah. I mean, because I know I can like the software that cost a ton of money a year ago when ChatGPT or whenever ChatGPT first came out. I mean, now it's like anyone could have that now. Anyone could build their own model or pre-built model, and nothing's really unique anymore. It's available to the public.
Well, the argument on the other side of that is, you still need to collect lots of data, and so Tesla, nobody else has Tesla's millions of, 7 million strong fleet, they say. But I think Waymo disproved that. I think Waymo has already disproved that in my mind. So um, I don't know. I don't think it's certain. I mean, I don't think it's certain that one side or the other will win. It's looking more and more likely that Waymo will get this scalable. Like let's say tens of thousands of robotaxis. I think Waymo will get there before Tesla, and so that means they did 2 3 cities with 900 7 8 900 less than 1,000. So tens of thousands, you're looking at a minimum top 10 cities, maybe top 20 cities in the US. So then what? Now what? What are you going to do as Tesla? You have a problem in your hands. And at first, it was kind of so. I mean, when Elon said 1 million robotaxis in 2020, if he did that, then you're looking at like really extreme margins. Okay. You can still charge $2 an hour that Uber is charging, and your costs are like 20, 30 cents per mile, etc. Even if it's 50 cents per mile, you're still making a ton of money. You make like 70%, 75% margins. But if Waymo has already also scaled, and now the cost of producing these models isn't as high as we originally thought. I mean, look at what DeepSeek from China just demonstrated, that they did it with 1 to 2 orders of magnitude lower cost after ChatGPT was created, and an average user can't tell the difference. So now, what's the point of spending tens of billions of dollars if you're not going to be able to charge an economic profit? And it looks like Apple reached that decision or realization way sooner than most other companies, and Apple just chose to, partner with ChatGPT, and Microsoft financed Apple Intelligence basically, and Microsoft has nothing to show for their tens of billions of dollars of spending. I mean, Microsoft is spending like $80 billion per year, and they have nothing to show for it. That is crazy, you know. ACDC.
Yeah, man. I just posted in the threads here. I don't know if you wanted to just take a look at that.
Let's see what ACDC posted.
Sorry, I'm getting in and out of my car. In
Yeah, that's
fact,
fine.
do you mind? Can I just come back
Yeah,
on the board in like a couple minutes?
yeah, that's fine. And I'll read what you said. ACDC post, and I'll pin at the top here. The greatest challenges have been interactions at scenes like a police incident or building on fire. When the autonomous vehicles get confused, they become immobilized and get in the way. We had many such issues. Autonomous vehicles also have a hard time interacting with humans who direct traffic at busy intersections. The vehicles get confused, particularly during special events or and motorcades. They're also flummoxed at construction sites. A Waymo vehicle just a few days ago drove into wet cement. Yeah, I mean these are edge cases, obviously, that are going to have to be solved one by one. And I guess Tesla's fleet allows it to kind of encounter these edge cases at a potentially at a higher rate than Waymo does. So we'll see. I mean, both approaches have their strengths and weaknesses, but Waymo is scaling pretty fast. There's actually a video, a YouTube video about Waymo scaling from a couple days ago. I haven't watched it yet, but it's on my list of things to watch. Waymo's Mawakana on autonomous driving expansion plans. Waymo co-CEO. This is from yesterday, Bloomberg Television. So I'm gonna have to watch this, a 20-minute video. If someone has watched it, please request to speak and let us know what you took away from it. I mean, I can't watch it now, but maybe I can just put the transcript into ChatGPT and see the highlights. But I want to watch it. So anyway, Steven.
I just dropped an article in the chat from 2 days ago. Memphis expressing concerns that they may not be able to fully support the data center down there for Elon.
Yeah.
So just because you were talking about data, compute, and all that, and I mean, Memphis is supposed to be like the big facility. So if they're not able to get the infrastructure that they need in order to run that place, it's going to become a disaster.
Yeah, we'll see. When ACDC comes, I want to ask him about Elon's comments around Optimus scaling. Or if anybody wants to come up, I mean, Keon, Wave, and kind of share the bull side of the things. It's becoming a bit too bearish in here.
I'm back
Sorry,
on.
I'm going to drop down anyway.
Yeah, ACDC, go ahead. Thanks, Steve.
Yeah, no, so I'm sorry I got cut off. I was kind of getting in and out of my car. But what I wanted to talk about was I just posted a message on the space thread. And it was a very interesting article, basically talking about Waymo's adoption now that they've had a few years in the works in these cities. And it was basically a Bloomberg article talking specifically about San Francisco. And there's a lot of hurdles. There's a lot of positives, but there's still some negatives and stuff. And they were talking about the congestion. They were talking about the inability of the Waymos to be able to function in some construction zones, emergency vehicles, and all that. So it's kind of like what I talk about when I say that the adoption is not just going to be the flick of a switch where everybody just starts taking, Tesla's robotaxis overnight. You look at what has just happened in New York with the congestion tax, right? These people are trying to reduce vehicles in these major cities and, not increase them. And something like a robotaxi, it only increases the number of vehicles that you're going to have in a city. So it doesn't really solve the problem in a lot of these cities. And in fact, it makes it worse because now you have a cheaper transit system available to you in the form of a robotaxi. So a lot of the mass transit users actually start adopting that also. So it was very interesting, that article. And I talked about, the roadblocks that robotaxis just as a whole, not Waymo in particular, just as a whole, are going to face in big cities.
Got it. Thank you. Yeah, the man, this is really crazy. It's the I mean, Waymo is scaling. Like I said, I'm gonna watch this and we can talk about it on Monday. Let's look at this article that Steven just posted. Memphis warns it may not be able to power Elon. A Fortune article from January 7th. Memphis warns it may not be able to power Elon Musk's lofty Colossus supercomputer expansion plans. What does that say for NVIDIA? That's the other thing here. In December, one of XAI's executives got up on stage in front of city leaders in Memphis and announced that Elon Musk's AI company was working on an enormous expansion to the Colossus supercomputer facility it had recently put together to train its AI model, Grok. The plant built out would create an even greater Colossus, a behemoth capable of housing a heaping 1 million GPUs, a 900% increase to the 100,000 GPUs that XAI's existing Memphis facility currently has. But an important wrinkle has recently come to light that could affect Musk's grand plans. Whether Memphis even has the power framework needed to support such a facility. During a Memphis City Council meeting on Tuesday, the CEO of Memphis utility company warned that such an expansion might not even be possible without building new infrastructure. People can announce many things. And I think that's important for our community, that we get excited about opportunities that are coming. But as you know, there's pragmatic realities about a lot of things. The CEO of the public utility that services the Memphis region said during the meeting. He added later, it is a physics problem, not a political problem, about how much energy can be provided here. Elon's not going to let that go. McGowan emphasized repeatedly that there are limits to the number of electrons that can be transmitted along power lines without threatening local or even national service. And he spotlighted how his utility company is legally required to review and study each request for service in order to prevent these kinds of disruptions in service. Also of note, XAI's first facility isn't even fully online yet. XAI has fired up temporary generators as MLGW, the utility, works to accommodate the company's initial power requests. The utility has had to reschedule construction for a new power substation, paid for by XAI, just to get the first 150 megawatts of power XAI has requested. And there's a second request from XAI for an additional 150 megawatts of power that is still in review, though McGowan specified the review wasn't done and it is still uncertain at this time when or if that load will come online. Without its initial power service yet online, XAI is now already publicly discussing a mega expansion of Colossus that could theoretically more than triple the amount of power it needs at that facility, depending on where XAI determines to expand. McGowan said that XAI has provided no formal details about what the expansion would entail or where it would be located. They're not ready for us to study it. We're not ready to study it, he said. XAI did not respond to a request for comment. The boom in Gen AI and the massive, I'm going to skip those two paragraphs. We are dealing with the physical realities of what our utility system can provide, the guy said apparently. Wow. I mean, that's big, right? A lot of these announcements are baked into the NVIDIA stock price. So, to the extent that even the grid can, like, it's not even possible in the near term. Let's post this. Thank you, Stephen, for sharing. Stephen with the news of the day. Look at that. I kicked this guy out. And now he's one of the bigger contributors every day. Physical realities. What a quote. So I mean, this is the kind of this is important for Tesla investors too. This is the kind of thing that you're going to have to do to perfect FSD. You're not going to be able to do it with your, you're going to run into these problems everywhere. And I don't know if mega packs are going to be ready. I mean, look at the amount of time it took to bring up the mega packs like Giga Texas. It took a year. They were supposed to be plug and play, which clearly isn't the case here. All right. ACDC, do you expect any sort of macro effects from the LA fires? What kind of trickling across the economy do you expect from the massive historic fires?
Yeah, so not really on a macro level, but I mean, you're already seeing a lot of pressure on the subsector on the insurance side of it. So, I mean,
I'm sorry, I was getting a
Yeah,
call there. I expect that to kind of continue
yeah.
here, but I don't really see a macro like. I mean, this isn't on the commercial side. This is mostly individuals who are affected, very deeply affected. But I really don't see any macro effects overall.
I think there's going to be some negative effects on Tesla's Q1 sales. California is the state where most EVs are sold. LA is one of the top two cities, I think, where Tesla sales or EV sales in general. So I think Tesla may want to put that on their earnings release because this is going to take a few weeks. Like the infrastructure it's going to take a few months to kind of come back up there. Life gets back to normal, and man, that's really unfortunate. I mean, that's the massive, massive. I didn't really follow it too closely in the last few days. I've been busy with a couple other things, but it looks like a really, really bad situation there. Hopefully people can go back to normal as soon as possible. But I estimate about a 10,000 car hit to Tesla sales in Q1 because of the LA fires.
wouldn't you think some of that would also be just absorbed by the replacement of the cars too? I mean, if those are the owners, they lost their cars, they lost everything, so they're going to be buying those same new cars.
Yeah, you're right. So maybe it'll just shift from Q1 to um, to all future quarters. I mean, actually, like this morning, funny you said that because this morning I was looking at the home builders. They jumped like 2, 3, 4, 5% because people thought that they're gonna have to kind of build these things, and then they got hit by the non-farm payrolls, um, pushing up the yields. So that's obviously a bigger problem for the stocks.
That seems to be such a headline news if home builders were jumping up though, because as mass as this or as large as this fire is and the damage is, it's still very specific to a certain area in the whole country, and there aren't too many home builders who are even focused in that. I mean, these are all private built, custom built,
Hmm.
private label homes. So
Hmm.
that
Yeah,
that just tells you the headline news there.
yeah, definitely, definitely. I mean, it is kind of up in Toll Brothers. You know, I think these are higher income homes, right? Kind of $1 to $2 million homes. That's like Toll Brothers segment right there. Anyway.
Yeah. And if that was the case, also if there were a few who were the beneficiaries of that,
Mhm.
it's going to take a while. From what I'm hearing, the Coastal Commission Board is one of the toughest places to get permits from and everything because of all of their regulations around environment and climate. So it's going to take a while for them to even collect their permits and start building back again.
Yeah, absolutely. All right. there's not much news on this new Model Y. I think it's kind of. I mean, I think some people were kind of expect. I mean, so my thesis on the Model Y sales this year versus last year was look at Model 3. The new Model 3 did not outperform the old Model 3 despite high expectations. I mean, I had very high expectations for the new Model 3 because they added $10,000 of value and they didn't change the price that much. But turns out these headwinds, that headwinds, I mean, also the political headwind just really went, crazy throughout last year. So there's also that. But go ahead, ACC.
Yeah, so the point that I was trying to add before was a fifth point to kind of like why you think Tesla will struggle is, and this is already, I mean, we had proof of this from 2024 sales, that in spite of EV sales from other manufacturers increasing, Tesla actually decreased. So we've come to a point where these other EV makers, they've kind of refined their models, they've refined their products, and they're able to take a market share. I mean, I don't dispute that Tesla is the best. That's why I own a Tesla. But a lot of the mass consumer does not know that. They have their brand loyalties. They have other reasons, could be political reasons. But these companies are here to stay. I mean, Honda is introducing an EV Prologue. There are people who are Honda loyalists who will never buy anything but Honda, just like how we talk about Tesla. Volvo is coming out with a new EX30, which apparently has been very successful in the European markets, and they're launching it in a rear wheel drive only option, which can be priced at like 35, 37 in the US. So that's going to be a significant product. So there's a lot of products that are also going to continue to eat into that share for Tesla too.
Yeah. Yeah. Yeah, exactly. I should have said that. Exactly. Chinese automakers eating, and others as well, eating into Tesla's share. I just asked ChatGPT what percent of the increase, so the range of the new Model Y increased from 688 kilometers to 719 kilometers. So you're looking at 4.51% increase, and 63% of that is due to the coefficient drag, and only 37% of other stuff. The weight increase, the decrease that you talked about, yeah. So nothing about the battery pack difference here. I mean, by this, like if you watch the battery day in 2020, by 2025, you would have thought Tesla should have a tighter feedback loop on battery, battery chemistry, battery production, and should have a better command on its supply, much better command, because they also said 100 gigawatt hours in 2022 by 2022, which is like a year into it. Is the end of 2020 was the battery day. A year to 2 years, they expected 100. So if you extrapolated that, you would have gotten to hundreds of gigawatt hours by this time, and they're not there, obviously. So now they're reliant on CATL. They're reliant on Panasonic. They're reliant on CATL, and even BYD. Like, what a shame to not. I mean, it's unfortunate. How unfortunate is it to have to rely on your competitor for a key material, batteries? That is crazy. Um, I think it's a very small portion of the battery supply coming from BYD, but still, to have to buy from your competitor for a key material, key inputs into your business, crazy. And I think they tried, but 4680 doesn't seem to have worked for them. And we got the sense of that when Drew left earlier in 2024. So, yeah. All right. The other headwind for Q1 sales, I think, is going to be this is a pretty cold winter. So I think January sales are going to be really bad. Cold January. Now you got the LA fires as well. And there's the Model Y production ramp in China, and then the Osborne effect of the new Model Y ramp in US and Europe sales. So it's going to be pretty challenging few months. for Tesla stock, I think. The other thing I want to look at, let's see. Let me see if this Reuters article has any more details that I haven't seen yet on ACDC. Go ahead.
I just wanted to add that yes, I mean we're kind of along with like you asking about the fires having any macro effect. Not just the fires individually, but if you look at all across the country, what we're seeing in terms of weather, one thing that's being ignored is this extreme cold spell that the Southwest is kind of experiencing. I mean, you've got more snow in Atlanta and in Nashville than I have in Chicago. So that doesn't also, I mean, that was a part that was kind of picking up on EV sales, including Tesla sales. That doesn't really bode well because, I mean, the cold temperatures are not great for EV range. And those people who were maybe even thinking of it, maybe holding off on those decisions too. So the weather has been kind of crazy all across the country. And one more thing is this supercharger now clearly available to everybody. And I know a lot of people and all the Tesla community, cheered that on as part of the mission and everything. I don't think that bodes well as a Tesla investor because that was a key advantage to Tesla. It was one of my key reasons for buying a Tesla also, that having their supercharger network. Well, now everybody else has it. So when you go to a dealer and the dealer tells you, well, you can charge it at any Tesla supercharger, then now that's another reason you don't need to consider a Tesla and you can just look at the other EV too.
Right. Okay. Oh, the other thing I want to do is the University of Michigan consumer sentiment. University of Michigan. Because the headlines talk about the consumer confidence, but there's nothing bigger news here on this one. Consumers express rising uncertainty. So first of all, why this is important is this is for January 2025. So it's January 10 today, and they do the survey over a few days. So it's still early on in the month, but this is the latest data we have in terms of consumers' expectations, consumer confidence, the most recent data. And you remember we talked about how I think things changed quite a bit mid-December. So consumers express rising uncertainty over path of inflation. Uncertainty estimated by 75 percentile minus 25th percentile expectations, 3-month moving average. There's a surge, especially in 5 to 10-year inflation expectations. There's an increase in year ahead as well, but there's a surge in 5 to 10-year inflation expectations. So this is survey based. The market-based data on that would be 5-year forward inflation expectation rate. And if you look at that, there's an increase, but it's not a similar surge. Right now, 5-year is at 2.32%. That's as of yesterday. Yeah. So there's no alarm on the market-based data, but the survey-based data is ringing the alarm bells here. And this is, I don't think, like for example, I don't think the gas prices, gas prices have been increasing over the last few days here, but in December they were pretty low, so they haven't yet started their surge. But oil prices have also been increasing. So sometimes these survey-based consumer sentiment surveys can be impacted a lot by day-to-day gas, food prices, etc. Index of consumer sentiment 73.2, lower than the 74 last month, lower than the 79 January of last year. So the year-over-year dropped 7%. Current economic conditions down 5% from the last year, but up from December to January. And index of consumer expectations down substantially, year-over-year and month-over-month. So let's read the commentary here. Consumer sentiment was essentially unchanged in January, inching down less than 1 index point from December, well within the margin of error. assessments of personal finances improved about 5%, while the economic outlook fell back 7% for the short run and 5% for the long run. So you can see like present conditions are fine, but the outlook is deteriorating. January's divergence in views of present and future reflects easing concerns over the current cost of living this month, but surging worries over the future path of inflation. Overall, this month's deterioration in the expectations index was seen across political affiliations, including declines of about 3% for independents and 1.5% for Republicans. Year ahead inflation expectations soared from 2.8 last month to 3.3 this month. The current reading is the highest since May 2024 and is above the 2.3 to 3% range seen in the 2 years prior to the pandemic. Long run inflation expectations rose from 3.0% last month to 3.3% this month. So that's a big problem for the Fed. That last two sentences for the Fed is a massive, massive problem. But again, this is survey based, and the market based data is not showing the same, although we've seen a huge increase in the longer end of the yield curve. ACDC?
In your opinion, what do you think is the situation with the labor market? Do you think this is a strong labor market as the report just depicted today?
I think it's weaker than the report showed, but the weakening seems to have paused. So we'll see. We'll see how that there's arguments to both sides, obviously. Um, it does take out the probability of a cut. I think the markets are pricing that correctly. I don't think the Fed is going to cut anytime soon. Unless next week we get inflation data that's much better than expected. If that happens, then maybe. But with unemployment rate declining, I just don't see how the Fed can cut. It's definitely not in the next meeting, but even in the next couple of meetings. Like there's some people now saying they're not going to cut at all this year. So I heard a couple of people talk about the probability of a hike. I don't think that's likely either, but yeah, we'll see. Like you can't. So there's one fact that you can't deny: the employment market is much weaker relative to a year ago. That is a fact on so many fronts. So you can't. Today's data doesn't change that, especially given the fact that these things are revised so often. So ACDC, so often and so much.
I agree completely. So here's an interesting take that I came across today. The Department of Labor uses the Census Bureau data, okay, and to calculate this rate of unemployment, okay. And according to the Census Bureau, they're estimating the U.S. migrant population to have grown by 4 million approximately. Okay, so and we know that not that entire 4 million has been employed. And if it has been employed, it's also been on the low end of the employment curve. So overall, we're still seeing many layoffs because of technology, including AI. I'm already starting to hear headline news where companies are reducing, stopping their hiring because they've reached those efficiency levels itself, right? So I think overall, organically, even though this employment number looks hardy, it's actually a weak labor market in terms of the pricing power of the consumer.
Right. Exactly. I agree. Yeah, I think it's weaker than people estimate, and but it's not weak enough for a cut. So there's also, initial weekly claims are still very low, like 200,000 per week, which is very timely data. They're not revised that much. It's still very low. I'm also not seeing, we haven't really seen a surge. Like there was a couple of big layoff announcements in December, but that hasn't really followed through to other companies yet. And but you know what I think is going to happen? These rates rising to 5% is really going to hurt companies who are not profitable and they have debt they have to refi. So these companies who have been borrowing a lot of money to finance innovative ideas back in 2020, 2021, 2022, before the Fed started hiking these rates, they have, several years out, 5, 10 years of debt on their balance sheet at low interest rates. And the longer that these rates stay high, and now they're actually even rising, and the later they refi, or higher rates they refi, their income statements are going to get slant. You know, we're talking some really major hits to profit margins, and credit ratings are going to get hit. So that's ahead. Like there's a wall of debt refis coming. So I think that starts this year actually. And this is true for personal loans as well. Like this is not just for companies, but also personal loans. And it's also true for the government to the extent that Yellen was using short-term treasury bills to finance massive deficits. Normally you use bonds, either, 5, 10, 20, 30-year bonds to refi, to roll the government debt. And she kind of took a break from that because she thought that inflation was transitory, as Powell did, as I did as well. And it turned out to be wrong. So the government is in a bad situation here too. So both the governments and the households and the companies are looking at this prospect of a massive refi situation. So companies with large cash balances on their balance sheet collecting these high interest rates, like Apple or Google or Mac 7, are relatively better situation compared to the small caps. That's why I'm like, when Tom Lee was talking about these small caps, I'm like, what are you talking about? A lot of these companies, I think majority of the companies are unprofitable. A lot of them are looking at this refi risk. And sometimes I wonder about that guy. He's not, I think he has an optimism bias that obviously pays off in a bull market, but when things turn, you have a situation in your hand. So he was wrong on Bitcoin. He said Bitcoin is going to finish 2024 well above 100,000, which didn't happen. He said that, I think, in September. And he was very confident in his short-term predictions. And he also talked about Russell 2000 small cap ETF back in July, continue to underperform throughout the second half of 2024. So to the extent that you listen to him and switch to small caps mid-year, you missed out on the second half of the Max 7 increases. I think in the next 5, 10 years, small caps will probably outperform Max 7 in the next 5 years. I mean, ACDC, would you agree with that?
I'm sorry, did you say in the next 5 years, the small caps will outperform the Max 7?
Yeah.
I think so. In my industry, we've always gone by growth and value rotating, and same with large cap and small cap. And the small caps are definitely due, but you're going to need a reduction in interest rates for that cycle to come, which I think it will be due for that. It's just that I don't think we got to the correction phase yet, and the Fed already started, reducing interest rates, which I think was based on political reasons. There was absolutely no reason to go in, especially with a 50 basis point cut in a market that was healthy.
Yeah. No, I think the 50 basis point cut, I mean, the employment market, I mean, remember the SOM rule situation there? The employment market looked like it was kind of snowballing for a moment there. It was looking bad. I think that was warranted. And I think that the interest rates are a little too high now, but not as high as I thought, I guess. So, but you agree that small caps will outperform Max 7 in the next 5 years? I think you said yes. So I think it's because Max 7 is just way overpriced. And if you think about it, you know, the unprofitable AI applications that the Mac 7 financed with tens of billions of dollars of investment, the beneficiary, I mean, everybody's beneficiary of that. So thank you, Mac 7, for doing that. But um, they're not seeing the benefit of that. OpenAI is losing money even at the $200 a month tier, which is crazy. You know, they're not profitable, and Microsoft, I don't think they've improved Copilot any materially because of these innovations, or it doesn't seem like it to me at least. Or their productive applications, I don't think people are using it as much. Like Zoom is sending, AI summaries, like meeting notes after calls, but I don't know if it's adding. Like it's unclear how much value that is adding to a meeting. Or Apple Intelligence got a couple of nice features here and there, but like, are people really using it? Is it really adding value? Would you pay for it? Would you pay for it? FSD, to those of us who follow it closely, it's good. And if I bought a Tesla, I would definitely get FSD. But would an average buyer do that in the near future? I don't think so. And they're not doing it. So, um, but a small company who is kind of motivated to leverage AI, whether it's ChatGPT or the other applications, then they can, get their companies off the ground quicker. They can grow their companies at a lower cost. So I can definitely see that being a theme in the next 5, 10 years. And they're valued. Their valuations are so much more reasonable today than Max 7. So ACDC.
Right, exactly. And that's exactly what, like I was talking to you about in the beginning of our call, that there's such a mispricing right now. And that's why I'm looking at the deep value side. And there's so many stocks that I'm stumbling upon. These stocks are trading at like low multiples and they actually have earnings growth. I mean, I'm looking at stocks that have got a 15 PE with a forward PE of 8, and nobody's looking at them. So when I was talking about the sector rotation, that's usually when that happens, and it's not really related on macro events, but it's related also to the market just mispricing and focusing on one asset class or one asset group, which right now seems to be technology and AI.
Right, exactly. Man, why are these financials down so much today? Any idea? PayPal down 5%, American Express down 2-3%, Visa, MasterCard down 2%, Berkshire Hathaway down 2, asset management down 3-4%. I mean, I get the asset management private equity part, but what about these banks? Like, if the consumer is doing better, shouldn't these banks be doing well too? It's a little weird. Insurance, property, and casualty down a lot. I mean, we get that. Capital markets, Goldman Sachs, Morgan Stanley down 3%. It's like fine. Moody's down 4%. They're down across the board in the financials. I don't really understand why. It's a little premature, but any idea?
Well, the way I look at it, most of financials are just big conglomerates, and they've kind of got their hands into everything. And especially if you've got your hands into asset management, capital markets, you're going to you're going to ride the highs of the market and the lows. But what's also coming into question is the balance sheets of these banks. And that's why I said that I'm not a buyer of an ETF or the banking sector as a whole. You have to look at very strong balance sheets, or the banks that have very strong balance sheets in that sector itself. So some of the banks, they're actually not down as much, as the others.
Yeah. Let me just finish the paragraph from the consumer sentiment survey. So we talked about year at the inflation expectation soared. There's one more thing I'm looking for, but it's not in the summary. So maybe there's a data that we're missing here. Let me see for a second. Man, these 5 to 10 year inflation expectations are crazy surged. Yeah, look at this here. If I can maybe do this on my laptop, and I can't. All right, I can do it here. Is this correct, or is this guy just like off here? Look at this at the top. Spencer Hakimian, 5 to 10 year expectations, inflation expected 3.3%, highest since 2008. Is that correct? Can that possibly be correct? Oh, look, Nick just said, Nick responded and said, it was also 3.3% in the preliminary survey for June 2022. It was revised lower in the final survey that comes out a couple weeks later. So I guess we'll wait for that. So they had a similar situation in June 2022. 5 to 10 year expectations, 3.3%. That would be insane. That something like that would be insane. So Nick replied to this reply from Spencer Hakimian, founder of Tolo Capital Management, global macro, market neutral, risk optimization. Interesting. Aiming for positive real returns in all climates. Not even less. Okay. I'm gonna follow this guy. And kind of keep an eye on stuff that he says. For now. Seems to know what he's talking about. Oh, look at that. He follows David Sachs, Roaring Kitty, Bill Ackman, Elon, Doge, Michael Saylor, Chamath, Nick Tamaros. Interesting.
Yeah, man, what's your take on Bitcoin's price action today? I cannot
I actually didn't look at
understand
it yet.
it,
Let me see.
and I
Oh, it's
can't correlate it to
95,000.
anything.
Yeah, it was down to like 91,000 something. And then it went up to 95. I mean, it's very volatile, which is, usually happens at the top. You get these volatile swings. But yeah, I think it's headed lower here from, but what do I know? I don't really know Bitcoin too much. But I did close my MicroStrategy short. So I guess we'll see. I don't think MicroStrategy. I mean, MicroStrategy can continue lower, but if Bitcoin stays here or it goes back above 100,000, then it's not wise to be short MicroStrategy at these levels. I don't think it's not a good return risk profile. Yeah, I mean, the Fed is definitely looking at this. 1 year and 5 year ahead, inflation expectations rose to highest levels in a year. And the person, Spencer, is pointing 5 to 10 year highest since 2008. That is not a pretty picture for the Fed. So no more rate cuts seems to be the name of the game here. And obviously that's going to hit the highest PE stocks the most. I'm looking to add to my Tesla shorts. I add a bunch to my Nvidia short as well. I think Nvidia's PE ratio is just is not calculated correctly by most people. So, and then Tesla, Axon, Carvana, I think is going to be pretty bad as well. What do you think? Any news on Carvana? Anything on anything you want to talk about on that front?
So I was looking at that, and I was actually surprised. So we discussed the Hindenburg report on it, and I thought it was pretty damning and pretty spot on with a lot of the things concerns that they laid out. And then you start seeing some credible institutions coming out and reaffirming their rating and supporting it, that no, it's okay, everything is okay. and that's what kind of like just shored up Carvana. It was like, okay, it's almost like a non-news now, and the stock kind of stabilized after that. I'm shocked personally myself.
Yeah, I think the Hindenburg report is just, it's good. They do their good research and everything, but there's a lot of speculation, you know. And looks like they did dozens of interviews, which is great. But I don't know who you interviewed. You're not telling me who you interviewed. I don't know if this is a disgruntled employee or some underlying real issues going on. But the one thing that, they opened up their research report with saying the valuations are high, which is my, investment thesis anyway. The other stuff is, I think, a lot of fluff. I mean, obviously, I'm on the short side of the stock, so if there's an accounting irregularity, that would be the cherry on the top. But that's not what I'm betting on. You know,
I agree on that, right? So to me, the most concerning parts were where were the sales coming from, right? So they're paying you top dollar, and that's why people were selling their cars to them. But how are they able to get rid of those cars? And it was from a lot of subprime lending. Well, that sounded great, and maybe it could have worked out if the interest rates continue to drop. But we're here now where interest rates have actually been going up. So that model does not work too well or for too long. So that's what I'm concerned about. Like, how's anybody not looking at that and, taking that in account? I mean,
Carvana stock is lower than before the when the report came out, by the way. And the credit institutions you're talking about just sell side analysts, right?
right, right. But I mean, it still bounced back. I think it went as low as like 170 or so, and it actually bounced back on some of those reports. So it just, I mean, they're the most leveraged play in this auto industry, and they're selling to where a sector of people where we're seeing some of the biggest problems. I mean, the
Yeah,
delinquency rates
they
and
were they
everything.
were they were above $200 per share. They were going up. I think before the reports, they were um, up around 210, and then when the report was released, it first surged, and that went down to 178, and I recovered. There was some couple of upgrades when it recovered above 200, which I added to my shorts, and now it's at 190. So I mean, significantly lower than before the research, and they said they've been shorting it before they published their research. So I think they kind of got into a short position, a pretty good position. I mean, I don't think Hindenburg like. I was in a different space, and people said like, oh, when they publish a research report, the stock goes up, and that's usually like the end of the trade. And I did quick research on Hindenburg, and that's not the case. When they publish their report, they actually have a pretty high hit rate. So, um, but yeah, like you said, the consumers that are like, I mean, Carvana like is a little surprising. It's not down 10% right now. That Nvidia is down after today's higher interest rates, but Carvana is not. That's a little crazy. So it kind of tells us sometimes these stocks just have a delayed reaction. So Tesla is in that bucket too. Sometimes it has a delayed reaction to news. Um, but what was your view on Amazon Auto as competition for Carvana?
So I mentioned that to you 2 months ago when we were talking about it, and you're
Right.
like, "Oh, that's not like a non-event."
I think
It's a
like
non.
did you say that in context of Carvana or did you say it in context of dealerships?
I'm trying to remember what we were talking about at that time, but I brought that up because I had Amazon up, and in fact, I was looking up their inventory as to what cars they have, and I think even till now they only have Hyundai on
Yeah,
there,
yeah,
but it's still a significant step. I mean, Amazon has proven, as a force in everything and anything that they can sell. And they can take that whole online process from all of these manufacturers and streamline it into a delivery process, you know, very easily. So I think it definitely plays a role into it. I mean, if these dealers they start cutting back on their dealerships. And of course, there's a lot more that goes on with it. They've got their networks, and everything. But there could be some smaller manufacturers who just take all of their dealerships and straight to an Amazon model in the coming years.
Exactly. I think you have to opt in. Yeah, I did some research on Amazon Auto. Like you said, it's all mostly Hyundai, and they say they're going to expand, but who knows when they're going to expand. But it looks like a CarMax model where no haggle pricing. You order online, they hook you up with financing on the website, hook you up with warranties on the website, so you're not getting um, you know keened, I guess. And then you go pick up at a dealership, a nearby dealership, but the dealership has to opt in. So I think it has potential. It's just that it can. I mean, Amazon starts a lot of things and then doesn't really follow through. So who knows if it's going to grow or not. So I don't really expect an impact on Carvana stock because of Amazon Auto anytime soon. Do you?
No, not a direct impact anytime soon right now. But like you said, I think it definitely has potential. I mean, even if the dealers just cuts out the commission of the salesman and Amazon takes that, that's a huge plus. And plus,
Right.
these manufacturers are getting to showcase their products on the largest retail site, which hundreds of millions of consumers are visiting every day.
Yeah. I mean, man, hold on. I'm going to show you something. I did a screenshot of the website, and I posted it. Look at this banner at the top. Did you see it? Did you notice it? Look at this banner. I'll pin it up here. This will take it like 5-10 seconds to come up. But find, buy, go, go, go. Click into that picture and look at that. I don't think you can see it on the screen right now, but I'm going to show this on YouTube as well. Um, let me see. This is ingenious. I'm like, can you even do this? Look at that. It says for a limited time, buy a car and get $2,300 in Amazon.com gift cards. That is wild. Like, why wouldn't you do that? You know? $2,300 in Amazon.com gift cards if you buy a car through Amazon Auto. Um, so I think in the future, I think it's going to take some time to roll out. Yeah, Amazon has to add other automakers on here. It can't just be Hyundai. Um, that's going to take years. But let's assume for a second Carvana stock is still up a year from today, or 2 years, 3 years from today, in the off chance that they're still up. And Amazon Auto, I think, is going to grow because of their ability to kind of like, cross sell with Amazon.com.
It will, but I mean, there's a clear distinction here: is that Amazon is only new car sales, and Carvana is
Right. Right.
only in used car sales.
But what's holding Amazon from also doing it for used cars? Right.
That's a whole different market. It would take them a while. I mean, if they can prove this model, then maybe they get into it. But that's a whole different. That's where we were talking about,
But see, I
buying
don't
used.
know because if the dealerships are opting in, and most dealerships have both new and used cars on the lot, why couldn't they also just opt in? Let's say Amazon has worked with this dealerships on the new car front. They have high, customer ratings, which obviously Amazon can implement as well. Customer reviews for those dealerships with high customer reviews, you can allow them to start also doing used cars in the future, right?
I get you. No, that's spot on. In fact, now all you don't need 5 or 50 salesmen at your dealership. You just need one intern posting pictures of all the used car inventory on Amazon's website.
Yeah. And then, dealerships, I guess, would rely on their ability to identify good cars at lower prices, etc. And then Amazon is just a platform. I mean, I guess, Car Gurus is doing that. There's a bunch of websites that do it on the used car site, right? But they don't have the brand value of Amazon. And they don't have Amazon's ability to cross sell with Amazon.com gift cards. So I don't know. It's an interesting phenomenon. Interesting phenomenon. What do you expect any impact from this on Tesla or Rivian?
Well, I don't think that they'll. I think the impact will be that one of the attractions of Tesla and Rivian is a direct to consumer model. So a lot of people who want that or who have experienced that and enjoy that, they can actually achieve that same model over here. So
Yeah.
it's no longer a
I think
niche
that
for
was
them.
I think that was the context we were talking about. I think we were talking about Tesla. Is it going to have impact on Tesla? And I said, no, I don't really expect so. Um, but Carvana, I think, could get hit here because of this. I don't know. All right, I'm tired. I haven't been getting good sleep in the last few days, and you can tell from my speech patterns. I can tell at least. But
Well, I wanted to thank you though for talking about varying different ideas, perspectives, and everything. And I hope everybody who's listening in here can appreciate that. I think most people who are still here do appreciate that. Um, One of my realizations in the recent time has been is that the more like I when I joined Axiomon, it was like I kind of my interest was Tesla, so I kind of got sucked into that community, and it was great and everything was all good, but I didn't even realize like how much of a vacuum that community became, and my thinking itself became being just in that bubble. And I think it's so important for people not to get carried away with it. People don't realize most of that bubble is basically incentivized on two things. One is gaining followers and monetized accounts, and thus, making money off that. And the second is making referral credits and off of Tesla sales and so on and forth. Okay. So there's a very strong bias from what you hear always. And I think this is so important to hear a different perspective, make your own decisions, but at least have a whole different perspective available to you.
thank you, CC. I appreciate that. Look forward to next week. Take care. Take care, everyone, and enjoy your weekends.
All right, take care. Have a good weekend, everyone.